Taxes are the single largest expense most people will pay in their lifetime. Not homes, not cars, not student loans, taxes. And I find it so surprising that people are ready to spend so much time scouting on the internet to find a $10 discount, but don't bother to take the time to educate themselves on something that is so fundamentally important to life. So in this video, I'll explain how taxes work and talk about the most common ways to legally reduce your tax burden. This is going to save you thousands of dollars every year. I know, tax laws are highly country specific, but there are certain aspects that are common and are applicable no matter where you are. So let's get started. If you are new here, my name is Srijit, and on this channel, I help you to become better at your finances. And sometimes we talk about taxes. Now, I'm not a financial advisor or a tax expert. I'm just a random guy on the internet sharing my experiences. So please do your research before you act on any of the things I say here. Most people believe that as the earning increases, so do the taxes. This is not completely true. Let's take the example of the wealthiest man on the planet and founder of Amazon, Jeff Bezos. Can you guess how much he pays in taxes? According to data obtained by ProRepublica, an independent non-profit organization, between 2014 and 2018, Bezos paid only a true tax rate of 0.98%. Now, true tax rate is the tax amount paid annually compared to the estimate growth in wealth during that time. Here is another example. Warren Buffett, widely regarded as the greatest investor the world has ever seen. He has a net worth of over 100 billion, but he just pays 0.1% in taxes. That's right, 0.1%. Buffett himself disclosed in a press conference that he was in fact paying less in taxes than his own secretary.
Debbie works just as hard as I do, and she pays at twice the rate I pay. I think that's outrageous.
I can easily give you another 1,000 examples. And then there is you and me, probably working on a day job, earning a monthly salary. And the end of each year, our employer mails us a tax statement. We take a look at it and wonder, why is 40% of my income lost to taxes? This world is not fair. It's true. The world is not fair. The rich have the circle of influence, access to tax havens, and an army of tax attorneys. But you and me, we only have ourselves. We have got to understand the tax system and find every loophole or opportunity to get back what's rightfully ours. As Ben Franklin said, in this world, nothing is certain except death and taxes. However, there was a time when taxes were not the norm. Taxes were only imposed on people in times of war. But then, the governments fell in love with the idea and made it permanent. But taxes as such are not a bad thing. Governments need money to work, and taxes are an important part of running a civilized society. The problem occurs when they are too high and are unfairly used against people. Most countries use a progressive tax system with marginal tax brackets, also called tax slabs, to tax the income. Tax slabs are like buckets, with each bucket having a different tax rate and limit. The higher the income, the higher the slab. However, this doesn't mean you pay a single rate for your entire salary. For example, suppose these are the tax slabs in your country. 0% for an income below $10,000, 10% for an income up to $50,000, 20% for an income up to $100,000, and 30% for any income above it. So if your taxable income is $150,000, you normally fall into the 30% tax bracket. This is called the marginal tax bracket. It's called marginal because only a portion of the income is taxable at that rate. You only pay the tax for the money belonging to each slab according to the corresponding tax rate. And this more or less applies to most of us, irrespective of what kind of job we do. Except for the rich business people out there, because they don't earn much in the form of an income. Tesla pays Musk around $37,000 annually. And Larry Page, the founder of Google, earns a salary of just $1 a year. If a rich man owns a company, he will not register himself as an employee of that company so as to avoid paying an income tax. The rich only pay capital gain tax and corporate tax, which are far lower than the income tax rates. Every government in the world knows that it's not fair, but still, each one of them allows this. Why? Because the government doesn't need you and me, but they need the rich. And if the governments don't make the rich happy, they will just leave. When you have hundreds of millions of dollars in your bank account, virtually every country is open to you. But what's the problem if the rich leave? The rich have the platforms, the companies, the corporations that provides the middle class with income. If the government hurts the rich, the economy will feel the impact. So what can a common person like you and me do? You will know if you are smart enough to watch this video until the end. The best way to save taxes is to reduce your taxable income. And there are two ways to do that. Either by making use of deductions or using tax credits. They both work differently, and I will give you an example to understand it better. Let's say you make $100,000 a year and you are taxed at 25%, which brings your yearly taxes to $25,000. Now, if you receive a $10,000 tax deduction, your taxable income now becomes $90,000 and your tax bill is reduced to $22,500. But now, let's say instead of receiving a tax deduction, you receive a $10,000 tax credit. Now that tax credit is directly applied to the $25,000 in taxes that you owe. So your final tax bill comes out to $15,000. And all in all, you save $10,000. So credits are usually better than deductions because they can directly reduce the taxes you owe. Governments around the world offer various tax credits. For example, in the US, a tax credit is available for those who install solar panels for home use. There are also tax credits that can offset the cost of child and dependent care. So go to your government tax website, search for available tax credits and make the most out of the ones that apply to you. Now, deductions are typically contributions to retirement and healthcare. In the US, this includes options such as the traditional and employee-sponsored IRAs and health saving accounts. You can contribute up to $7,000 into a traditional IRA, $23,000 into a traditional 401k, and $4,150 into an HSA tax-free. This comes around to about $35,000 in tax deductions simply by saving for the future. And if you're married, you can get twice as much. In my home country, India, we are allowed to invest up to rupees 150,000 a year into a pension fund with no tax on interest and no tax on your gains on exit. Such deductions are gifts from every government to the middle class. So use them to the fullest. Now, my personal favorite way to reduce taxes is by having expenses. In every aspect of life, having more expenses than income is bad, except for one, filing your taxes. This is what the rich do most to reduce their tax burden. The rich run businesses. And what do businesses have? Expenses. If Bezos made 10 million in profit this year and he wants to avoid 2 million in taxes, what does he do? He buys 250 Amazon delivery trucks worth $10 million for his business that can be deducted from his profits. And now, in the eyes of the tax office, he didn't make $10 million. He made $0. You don't need to own a big company to benefit from tax deductions. But you need to understand that the tax code is tailored in favor of people who earn money outside a full-time traditional job. So if you have a side hustle or even a freelance gig, you can write off your expenses against your personal income. I did this with my YouTube channel. Last year, I bought some camera gear and a laptop which I claimed as business expenses and got a considerable amount back from the tax office. Investing can be an important tool in growing wealth, but it can also help to save taxes. For example, in the US, if we lend money to the government in the form of municipal bonds, the income we earn will be exempt from federal, state, and local taxes. Every government provides such tax-free investments, so it's worth having a look and consider investing in them if you want to reduce taxes. But even if you don't invest directly in tax-saving government securities, every other investment we make saves us taxes. Because profit from our investments are not taxed at the normal income tax rates that we saw earlier. I will explain. We can all agree that when it comes to investing, the goal is generally to sell our investments at a higher price than what we purchased them for. However, when we make a profit from selling something we own, like an investment or a piece of artwork, we incur capital gains. And this is taxed at a rate based on how long we held on to the asset before selling. So if we sell a stock after holding it for less than a year, we will face a short-term capital gains tax. However, if we sell a stock after holding it for more than a year, we will pay a lower long-term capital gains tax. Both these taxes are normally far lower than the high income tax we have been paying for our salary. So the key takeaway is to invest in assets, hold on to them for the long term, and make most of your income from capital gains. But then that's not it. There are also other strategies available to further reduce the taxes from capital gain. We can use our investment losses to offset the taxes we would pay on other investment gains, thereby lowering our taxable income. This is called tax loss harvesting. And then there is the buy, borrow, die strategy. This technique is often used by the rich to pay zero taxes on capital gains. Under US tax law, we don't have to pay any tax on investment gains until we sell, no matter how much they have gone up. This is known as unrealized capital gains, and the rich, they never sell. Because why should they sell and pay capital gain tax when they can easily take out loans with the investment assets as collateral? And the best part is that the interest rate for these loans are lower than what we can get with a traditional loan. The core idea is to purchase assets that appreciate in value, borrow money against these assets, and then pass on those assets to the children. If philanthropy is important to you, and if you regularly donate to charities, you can declare your donations on your income tax returns and qualify for a tax refund. Just keep in mind that to claim a deduction, you must have donated to a charity recognized by your tax office. I know, talking about taxes can be a bit daunting, but if you can put some effort into understanding and educating yourself, that knowledge can save you a lot of money every year. I hope you got some value from this video. Until I see you with another video, have a wonderful rest of the day and adios.